Hi, everyone. I'm Ivan Bayuki, and welcome back to Wall Street Silver. Our guest today is Thomas Thornton, former portfolio manager, technical analyst, and now founder of hedge fund telemetry. Welcome back, sir.
Hey, nice to see you guys. Great chatting with you always.
Well,
It's a real treat.
you've been having a great year. You're up well over 22% this year on your management money. Congratulations. It's a tough year out there, and you're one of the successful guys. We love having you on because you're a totally different perspective than most of our guests. So we appreciate it.
Well, truth be told, this last bounce has really sort of taken away some of the gains that I had. I shorted some things a little early, and
Bed Bath and Beyond. Are you a meme
No,
right now?
I try to avoid the obvious, especially with high short interest type stocks. It just doesn't make any sense. I'd actually buy the high short interest stocks. That's sort of, I'll fight the hedge funds myself.
Yeah, you're advising them and fighting them at the same time.
I tend to advise the ones that I talk to avoid stupid, obvious squeeze candidates that you just can't get yourself out of, and especially when you have a mob going against you.
Well, I mean, you're being quoted on Wall Street Bets now on Reddit now, so it's you're getting quite some notoriety.
Okay, let me back that up a little. So I tweeted out, and I actually deleted the tweet. I had a lot of responses, some very colorful ones as well. I said the CEO of Bed Bath & Beyond had bought out of the money calls. It's actually Ryan Cohen, who is a board member, which essentially still has the same responsibilities and ethical duties, but he was buying tons of, millions of dollars out of the money calls, causing a gamma squeeze.
Mm-hmm.
And, it's just out in the open that you can do a gamma squeeze, just like we saw in Tesla.
And we all know it wasn't Elon doing that gamma squeeze on Tesla, right?
No, he wouldn't have anything to benefit from it, right? The largest shareholder.
Right.
No,
yeah.
No, not him.
And I'm sure he had nothing to do with all those options on Manchester United or any of that.
No.
Yeah, we won't go there. We're getting off topic.
Oh man, that one might get him in a little more hot water here with the SEC.
Yeah,
we'll talk. We'll do that.
If Jeff Bezos came out and said, "I'm buying XYZ," and the stock rips, the SEC would be all over him. If Warren Buffett did that, people would be all over. That's where Elon just plays by different rules. And it was a joke. Oh, okay, sure.
Well, I mean, he owns SpaceX. He's like a national strategic asset now. I mean, the government can't do without him. He controls their access to space, basically. So
send him up in the rocket.
Yeah. So hey, let's get back on topic here.
Okay.
Because we're big macro guys here, and I know you follow energy really closly, and energy is going so crazy in Europe that we're seeing things like smelters are shutting down. This one is another zinc smelter just shut down.
Right.
Europe, and this one, one that makes aluminum. This one's in Slovakia. Smelters are hugely energy intensive, and we all know that Europe's natural gas prices and the water levels are so low that the nuclear power plants can't run. Electricity's gone crazy, like up 1,000% in many of these areas going out for the next year. I mean, what are you watching for right here? Is this interesting to you as a trader?
Well, it's good for a macro perspective because I think that Europe is really in a lot of trouble with their economy. I mean, UK, which is no longer in Europe, they had 10% plus CPI today. And I think that the inflation numbers are just going to get even higher in Europe, ultimately causing a recession. And the energy crisis is just going to be dire. Everybody I know that I speak to that is an energy specialist is just absolutely out of their mind, saying that this winter is going to be, people are going to freeze.
Wow.
And from the macro point of view, if there's a lack of water and there's a lack of energy, those factories, again, they will close. So if it's the producers like a zinc closing, that's going to hit auto production. That's going to hit a lot of other types of industries they're going to have to pay up for it. So they're essentially PPI is going to go through the roof. And I think that there'll be shortages again. So it's really a dire situation in Europe. And I don't think it's getting enough attention in the US. That's just something I'm really watching. And that, I think, will become a bigger issue into the fourth quarter.
If Europe goes into a major recession, which I don't think I don't know how they can even pretend they're not about to have a recession with everything going on there right now. It's not like they can have a major recession, deep recession, and it doesn't affect the United States. And there's so much trade between these countries, we're all linked together. It tips us over. I mean, a lot of people think we're already in a recession in the United States. Where's your feeling there? And is it right that we should link these two? Europe's problems have to trickle over into ours?
Yes. I wrote, yeah. Simple. Next. No, seriously, something I wrote about the other day was the new orders across the globe with China have dropped down 30% in some industries. Mm-hmm. And you also see these super high inventories at retailers in the US. And I'm actually a little shocked that Walmart and Target and Home Depot, their earnings, despite having high inventories, we're seeing as sort of positive that they've worked down some inventories. They didn't work down that much. And the big problem with orders right now is this is the holiday season that if the orders are dropping like this, and it's not necessarily just coming to the US, a lot of it is in Europe. So the European companies that are reselling products or manufacturing products that they get partly from China, they're cutting orders big time. And that to me says that there's a glut in the world of inventory. You've seen semiconductor companies, which that to me is the leading indicator for economic growth.
Right.
You're seeing these big semiconductor companies guide down from, let's say NVIDIA, they make graphic cards, they go into various gaming computers, they go into data centers. The problem is they have tons of inventory. They had a $9 billion revenue rate for next quarter. They cut it to 7.5. And I think it was B of A or Citi I read today. They think it's going to come in around 6 billion. So that's a huge 30% drop. Right. Guess what? The stocks just keep going up and people ignore it. So it's going to come to a point where the better than feared earnings that we had this last month are going to become worse than expected. And that reminds me of in 2002, we had a ugly market in the beginning of Q2. Earnings came out better than feared. The markets went up. And then all of a sudden, companies started guiding down bad and big ones. Nortel Networks, Cisco, Dell, Microsoft, Intel, Apple, you name it. Every chip company had inventory. And if that happens, the market went down 30% that fourth quarter, third to fourth quarter, that period. So, it reminds me of that. So I'm concerned. And the market's bounced and nobody seems to care. And the Fed's raising rates. And
are people expecting the Fed is going to have to pause in the rate hikes? If Europe's in a recession, the United States is in a recession, it sort of becomes politically impossible for the Fed to really just keep raising rates. They've just done a little bit of quantity, selling off their balance sheet, in the less than $100 billion, I think has been reduced at this point. At some point, if we're in a recession and it's official, they can't really keep raising rates, right? Or do they just ignore it and keep going and keep?
Well, their mandate is to control inflation. And everybody celebrated that we had 1 month down in the CPI month over month. It's still 8.5%, and they want to get to 2%. A lot of economic damage is going to have to take place for that to happen. Maybe the Fed is okay with the equity markets lifting, because they can then have total clearance and total cover to continue to raise rates as aggressively as they want. QT is going to double to almost $100 billion in September. That's not being talked about enough. And I think that I'm really worried about the housing market really hitting a tailspin. There was a lot of pull forward demand, and that could start to really slow in the next couple of years, especially if rates keep going up. Mm-hmm. But as far as the Fed, I don't think that they're going to stop at all. I don't think that there is any chance that they're going to stop and pivot based on there's a lighter than expected data point came in. Inflation is going to stay high. Mm-hmm. I mean, what's gone down are used car prices have gone down, hotel, airlines. Those were transitory type inflationary inputs, but wages aren't going down, and you're not seeing the unemployment rate go up. It's 3.5%. The Fed's not going to pivot at 3.5% or even 5%. And even if they do pivot or slow, and the market will have a short-term bounce, they may just stop doing anything and let inflation come down and let those higher rates seep into the market and control inflation. That's what Neil Kashkari said. And as much as he was the Uber dove and now he's the Uber hawk, I think that from the people I've talked to that are Fed insiders, they said they're going to get to 3.5% to 4%, could go to 5% if inflation doesn't come down. And then they're going to stop. They're just going to sit there. And so for everybody to think that, oh my God, the Fed's going to pivot and everything's great. No, that's not quite going to happen. And maybe they'll slow a little bit if the markets come down and ahead of elections. Maybe they'll go 50 basis points instead of 75 or even 25. But the Fed doesn't want to be seen as a political influence ahead of elections. A lot of times in the past, they've stopped doing anything around August and or July even. So, I just don't think that. It's a bad setup for President Biden and the Democrats going into the midterms, because I think inflation is going to stay relatively high.
Well, I know you told us earlier that you think this sort of rally in the market's sort of running out of steam, and would you touch on that? Why you think it's running out of steam, and if there's any ideas that you're sharing with all your hedge fund buddies that you want to hear? just between you, me, and Ivan. No one else has to hear about it. Just me and Ivan. Let us know what you're doing right.
Okay. Well, truth be told, I did. I was long stuff off the lows. I've caught the bounces really well. I've actually traded more long ideas than short ideas this year, and which is strange in a bear market. But I've caught some of the rallies off the lows pretty well. But this one, it bounced, and then I started shorting things, and I was too early. And so yes, it's a little painful. I'll be quite honest. But I think that we're coming into a seasonal period that gets weaker in the middle of August, going into September. I think you're going to you have a void here between any super big economic news. You're going to have the Fed minutes today, and then Jackson Hole. And I don't think that the Powell or any of the central banks, with the data that we have, are going to seem any bit, let's say, dovish or less hawkish. I think they rolled out all the Fed governors to say, hey, the markets, you're getting ahead of yourselves. I think Powell's going to make that abundantly clear. And so I think that's happening. Mm-hmm. Inflation's going to stay high. If inflation goes to 7%, that's still historically so high. Even if it's at 5%, it's going to really hit the consumer. And the longer it goes, the consumer's savings, which have been abundant, and we're now starting to see that drop off. You're seeing spending for retail. A lot of consumer credit card debt is starting to increase, which is basically saying that people are trying to keep their lifestyle going using credit cards. This just gets to a point where the consumer is going to say, oops, we're kind of done here.
Right.
And I think that's what we're going to have for the next quarter to maybe next year. I think it could be tough. It could be longer than everybody expects. We've had short-term little, markets go down and then they be bottom and the Fed pivots, but a recession, the ones I've been through, they take longer and last longer than anybody wants. And you see bankruptcies, you see people losing their homes. We're not really seeing that in the corporate world. And so I think that it's a dangerous place. And I caution people to say, if you've got good gains off this low, take them. This is a tactical market. This is my main thing that I've told every single person. You've got to tactically trade this market. You cannot say, oh, I want something from the long haul, because you could just get, a 10% move up and then wham, it goes down 20%. And in 2000 and 2008 through 9, we had these 50% drawdowns in the market, some indices even more, but you had a bunch of 20% or higher bounces within those. And if you just said, oh, I'm, at the top, I'm going to just stay short, and you were involved in a 20% bounce, you start to really worry about, am I right staying short? Nobody has a crystal ball. Maybe we did find a bottom. So you just have to be tactical. You can't make big predictions, and you can be wrong and get out of things. And because this is the type of market that you do get an excuse, a free pass for being wrong on things. That's certainly how I see it. Try and be wrong. I like to tell people, be wrong selling something at a profit too early. That's your biggest sin. But if you have to take some losses here and there, it's a tactical market.
Well, do you ever follow Michael J. Burry? Do you see he sold everything?
Yeah.
The other day,
went to a private prison. Just left one private prison.
He has one stock, and it's a private prison. He sold everything else.
Yeah, I really like him. He's a very interesting guy, and his tweets are, they make a lot of sense to me. Partly because we also were very short. Our firm, my old hedge fund, we were very short financial assets and CDX and things like that. And, the guys from the Big Short were, Front Point right down the street from us. We had the same massive $1 billion positions on as well. And, we did well, but
a movie about you?
No.
Yeah. Where's your movie?
No, they did. The first seasons of Billions is about my firm, but that's a whole nother thing. That was not fun either. But one thing to remember is like I was talking to a financials focused hedge fund guy the other day, and he said, Tom, do you realize that Bank of America went up 100% in the middle of its downturn? So you could have these rips that just take out all the shorts. And that's another thing. This is really important. We should have talked about this, but this is the money. All the prime brokers around the street. The prime brokers are Goldman, Morgan Stanley, Credit Suisse, Bank of America, JP Morgan, all of them out there are custodials for hedge funds. So if I'm a hedge fund, I can have money at custodied at Goldman, Morgan Stanley. And if I make a trade, I can trade with Citibank and it'll go to the Goldman Sachs account.
Oh, really?
Custodial. Yeah. So that's just how, and I had 100 different trading firms that I dealt with way back, and they knew where everything was going to go, but it was housed at one place. The prime brokers see amazing information. I mean, if you can imagine what they could see, what every client is doing and where they're positioned, they put out research daily. And sometimes the weekly reports are even more interesting. Shorts have covered in the last month. There's only been 2 times since they've been tracking it that it's been higher covering rates, dollar notional rates. So this entire move has been a covering move. And you can look back, I think it was June, the beginning of June, there were like 2 big gap down days in the S&P and the whole market. And the shorts were pressing there, unprecedented pressing of shorts. That means they were increasing their shorts. And so as we lifted above that, they've now had to cover. Now, here's the problem. If you don't have shorts in the market, which is basically demand going up, or buyers, future buyers,
right?
And something goes down, if you don't have those shorts, you could possibly see a lot lower type move, because it could be like a vacuum lower. So bad news can be really bad. And so, like, if you see, for example, if you see a particular company report really bad news and the stock goes down a little and then it starts to go back up, those are just people covering. That's it. So if you don't have those shorts there, you have a lot of longs that and a lot of FOMO has been happening. So you have a lot of longs that could get trapped here. And that, to me, is a precarious situation. And okay, so there's another thing I look at is I look at VWAP levels, and I calculate VWAP levels. And VWAP means is a volume weighted average price. So I will take a particular moment in time, and I've been looking at the exact 8:30 a.m. print of the CPI on the 10th to now. And I look at it generally on a lot of things, but I look at the SPY and the Qs. And that number on the SPY is 424.60. It's 424.90 right now. And on the Qs, it's around 328, and we're at 326.60. What that means is all that volume and that buying up there, those people are potentially trapped. And nothing motivates sellers more than seeing what they just bought turn red. And that's why I think the market possibly could have topped on this bounce.
Thomas, I love talking with you, man.
Yeah.
I love talking with you guys too. You guys are awesome. Our off the record comments are even better.
We talked for 10 minutes before we would start recording. But I love having you on, and because you're such a different perspective than any of our other guests that we have. You're
right.
The hedge fund industry. You're like our only guy. You're our only in for that world. And we just love having you on. And thank you very much for joining us and giving us a part of your day. We appreciate it.
Thanks. I always like coming on, chatting with you guys. We have very like-minded beliefs. So awesome.